Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ICE raw sugar in New York. I must apologize once more for the multitude of lines and labels that I have had to draw on this daily chart. However, technically, there's a lot going on here, and these labels and lines are all valid in my deciphering what is actually going on here. The declines early this year, below the long moving average, currently at 1881, are as a result of three patterns created between August 2021 to January 2022. I've already previously highlighted these patterns and even pointed them out with a cursor, so I will not spend too much time on them other than to say they are complex versions of normal workaday patterns. They are: 1. Complex head and shoulders top from August to November 2021, neckline currently at 2102. In fact, I'll stop referring to this one as the sharp ascent of the neckline means that the market has already reached the appropriate targets below the neckline by just doing what it has done during February. The second one is a complex triple top from August to November 2021. Neckline is currently at 1980. This one is very interesting as prices 3 weeks ago tried to break higher with an immediate countering weekly key reversal up. This led on to Monday, that's Monday, 2 weeks ago, peaking, and especially Tuesday 2 weeks ago being capped by the neckline at the time. Thus, it would seem this neckline had some significant capping ability, especially on a possible move higher. Finally, 3. The most recent and an awkward head and shoulders pattern from October 2021 to January 2022. Neckline is currently at 1759. This pattern is still ongoing, and I have carefully considered it throughout January and February, as prices tried ever so hard to break it. However, since that time, and especially after the previously mentioned immediate countering weekly key reversal up, this neckline and the associated head and shoulders pattern have taken more of a back seat. Thus, not a head and shoulders top, and also not a head and shoulders continuation pattern. Indeed, what we have seen since the rejection overhead of the neckline 2 weeks ago has been an attempt lower. Yet this attempt has been stymied by a whole plethora of supports. To name just the immediate ones, the combination of the February 2021 high at 1894 and the medium moving average, currently also 1894. The rising long moving average, currently 1881. Now, most significantly for me, the middle time of the big December 2020 to April 2021 move, currently at 1866. And the base of the support last week, the flatlining short medium moving average, currently at 1881. Now, this congestion between 1851 and 1894 has been enough to turn the market back up and out of the zone. Well, for now at least. So where are we now? We are in a dead zone between the overhead and rising neckline, currently 1890, and this congestion zone below, currently between 1851 and 1894. There's one other item I'd like to look at before I finish here. It's to look at the whole of the 2022 action, maybe even including the fall in December of last year as a possible double, maybe triple bottom type action. I've not yet made up my mind on this, as it seems to be another complex pattern, but it is nevertheless still there. ICE Europe white sugar in London. The market made a big meal out of the breakout of the September 2021 to February 2022 lopside diamond pattern. There are a number of false breaks in both directions, including a gapping changeover. Until 4 weeks ago, the market made a gapping move higher through all the moving averages, and finally 3 weeks ago punched over the 2021 high at 530.60 and filling in a gap between 531.70 and 532.70 left over from March 2017. However, doing that was enough on the upside, or rather reaching up to the March 2017 high at 548.70 was enough on the upside. Interestingly, the fall halted at the congestion from early 2017 at 517.80 last Tuesday, and after two indecisive patterns on Tuesday and Wednesday of a pair of indecisive spinning tops, the market turned back up with a somewhat unusual pattern last Thursday. Now, On the surface, last Thursday's action on its own could be seen as a shooting star pattern, type 1 bearish. However, that was not the result on Friday or today. Instead, we had an aggressive move higher, including, at least so far, a gapping move higher today. Now, a fit for such a pattern would have been last Thursday being classified as a bullish inverted hammer pattern. It was, after all, in the right place. However, bullish inverted hammer patterns are not just a one-day pattern. They are in fact a minimum of a 2-day pattern, with a bearish black marrow bozo on the day before the inverted hammer pattern being the minimum requirement for the action to be called at. Well, in this case, the 2 days beforehand were indecisive spinning tops and rising ones as well. Hence, I've decided to label that day's action as an unusual shooting star pattern type 2 bullish, although I still have my doubts about it. Anyway, since then, we have had a significant move higher, as previously mentioned, a potentially gapping move higher, with last Friday being, of all things, a confirmatory daily key reversal up. This now leads to a number of questions I've posed myself, and which turn I pose to you, thereby trying to explain the market and its opportunities. The first two are a somewhat lagging indicator and a pattern. We have the possibility of a golden cross of the short-medium moving average, currently at 504.60, up over the medium moving average, currently 505.10. If this happens, it will be during this week, but please remember, while still a bullish indicator, it's a lagging indicator. The second is a pattern. In this pattern, we should look to regard the whole November 2021 to date action as a very rare double, triple, quad, or even quintuple bottom. Now, the primary target of such a move has already been reached at 539.5. However, the secondary target is at 548.70, which is the same as the previously highlighted March 2017 high and the cap on the market from 2 weeks ago. Freaky, is it not? Finally, there is an opportunity. It's to look at the late February to date action as one of two patterns, either a possible bullish halfway hesitation or a possible double top, based on that same cap at 548.70. Now, it's too early as yet to say which is which, or if they are either at all. However, I did float the idea of a possible bullish halfway hesitation last week, and I can provide some possible points to look for in both patterns, if one or other comes about. For a possible bullish halfway hesitation, we have a possible point in the 570 even area. Meanwhile, for a possible double top, we have an initial point in the 498.5 area, with a secondary point in the 487.5 area, well below all the moving averages. This is what I can see so far. Sugar white premium. The spread. Last week, I spoke about how we were back up to 3/4 key patterns running in this market. The first was one I'd mentioned many times before, the mid-August 2021 to date uptrend, currently at 105.25. This is still quite a steep angled uptrend and one I would normally regard as having a limited lifespan. However, it has been in operation all this time and during its lifetime has become a 5+ pointer uptrend. Thus, this is one to always watch closely. The second is another one I had previously mentioned. It is the quiet and subtle bullish bow tie formation formed over Christmas. It consisted of the rising short moving average, currently at 115 even, the rising short medium moving average, currently 101.25, and the recently flatlining but now starting to rise long moving average, currently 77.25. What had been interesting at the time of its formation was how all the moving averages went in and out of the bow tie in the right order, a rare feat in some markets. Theoretically, the market should move in the direction of the outgoing moving averages, in this case higher, which we have already seen. However, the key move again, theoretically, should happen between 15 to 20 trading sessions after the crossover. In this case, it will be between the weeks of the 4th of April to the 9th of May this year. Hence, I repeat my suggestion of recent weeks of putting a note in your respective diaries and calendars for that period, just in case. The next utilizes the existing uptrend but connects the tops since July 2017, such that we have a huge ascending triangle pattern, currently 104 3/4 to 112.5. As I said over the last few weeks, running up to today, in the next few weeks, and I quote, "This pattern will be squished into nothing, so it may well be that we'll have a break higher or lower soon." Now, I cannot give an idea of which direction as yet, but I can give an idea of the size of the move. For a break higher, it would be about $50.50 on top of the upper trend line, whilst a break lower would be $25.75 off of from the lower trend line. And that's the end of the quote. I even proposed some ideas for the move higher and lower, though obviously without giving a target, as we had not, as at last week, had a break higher or lower. I'll come back to this ascending triangle pattern shortly, but first I would like to discuss the one final pattern I had seen. I spoke about it this way last time, and I quote, "Finally, there is a pattern which, whilst not directly touched, may be indicative of the bullish angle of attack. It is the 2019 to 2021 bullish Andrews pitchfork. The market is currently in between the middle time overhead, currently at 129 even, and the lower time below, currently 54 3/4. Once again, no time has been touched, but the upper trend line of the ascending triangle runs approximately parallel to the middle time, and that is also something to watch." End of quote. This bullish Andrews pitchfork is still operational and provides the next major obstacle before the market tries up to the May and June 2020 highs at 134 1/4. Now back to the ascending triangle pattern previously mentioned. Well, 2 weeks ago, the upper trend line, currently 112.5, of the pattern was breached. This was not the break higher, as the market had tried and failed to break higher before. However, last week there was a big break higher for a bullish engulfing pattern, this after 2 weeks of indecisive patterns, which saw a first strong weekly close over the upper trend line and out of the pattern. Additionally, I suspect this action may have triggered some stops, as the prices punched up over the 2021 high at 116 even, closing well over it. So far this week, with just only 1 day gone, well, partially gone, we have seen a gapping higher open since filled in, and a strong move up towards the middle time and the 2020 high. I spoke earlier this week and in recent weeks that a break higher, assuming that this is not a false break, would see a gain of about $50.50 on top of the broken upper trend line. Well, I can now give an idea of a possible target X for this, which is in the 162 even area and way up off the top of my daily chart. This is what I currently see, and it gives a big assumption that this break higher is not a false break. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.